Harry Helmsley died on January 4, 1997, having built one of the largest private real estate empires in the history of New York City. A portfolio that at its peak comprised office buildings, apartment complexes, and hotels across the metropolitan area, with an aggregate value that independent analysts estimated at approximately $1.7 billion. The management of that empire and the criminal prosecution that had preceded Harry's death by 8 years were primarily associated in the public consciousness not with Harry Helmsley, but with his wife Leona, whose management of the Helmsley Hotel properties and whose prosecution for federal tax evasion had made her one of the most publicly reviled figures in American corporate life during the late 1980s and early 1990s. The Helmsley Palace Hotel, now the New York Palace, at 455 Madison Avenue, was the centerpiece of the Helmsley Hotel portfolio, a property created by the incorporation of the historic Villard houses, 4 Stanford white-designed brownstones from the 1880s, into the base of a modern hotel tower that Harry Helmsley had developed in 1980 in partnership with the Archdiocese of New York. The building combined one of the most significant ensembles of Gilded Age architecture in Midtown Manhattan with a 55-story hotel tower, creating a property whose historical significance and physical quality made it among the most prestigious hotel addresses in New York City. Leona Helmsley was convicted of federal tax evasion in 1989 and served 18 months in federal prison between 1992 and 1994. She died in August 2007. She left the majority of her estate, which included the hotel portfolio and other Helmsley real estate assets, to a charitable trust whose primary beneficiary, she specified, should be the welfare of dogs. The forensic entry point for this case is the relationship between the institutional identity of a real estate empire and the personal identity of the figures who built it, because the Helmsley case documents with unusual precision the proposition that a real estate portfolio assembled through the combined efforts of 2 individuals can outlast both the individual's institutional credibility and, in Leona's case, their personal liberty, without losing the underlying commercial value that the portfolio represents. If this is your first case file from this channel, subscribe now, because every episode adds one more layer to what you are about to understand about the architecture of institutional failure. The Helmsley real estate empire's governance structure was built around Harry Helmsley's personal deal-making capacity and operational relationships, which he had developed across 5 decades of New York real estate transactions beginning in the 1930s. Harry Helmsley's approach to real estate investment reflected the specific characteristics of the mid-20th century New York market: patient accumulation of minority interests in large buildings, management fee income from properties where he held operational control, but not majority equity, and the gradual consolidation of positions that allowed him to eventually control assets whose aggregate value far exceeded his equity investment. Leona Helmsley's role in the empire evolved from executive management of the hotel properties to the public face of a brand whose aggressive promotion and whose demands on staff and contractors documented the specific management culture that the tax evasion prosecution would eventually expose. The covenant that the Helmsley Empire's governance structure did not contain was the one requiring the business to operate at arm's length from the personal financial interests of its controlling figures. The tax evasion prosecution established that Leona Helmsley had charged personal expenses, including renovations, to the couple's Connecticut mansion, Dunelin Hall, as business expenses of the Helmsley Hotel properties, a practice whose forensic documentation by federal investigators produced a criminal record whose specificity was unusual. A defendant whose personal behavior had been characterized by such contempt for the distinction between personal and business finances that the documentary record of the commingling was extensive and unambiguous. The quote attributed to Leona Helmsley, reported by a former housekeeper and repeated in the prosecution's public record, that only the little people pay taxes, became the most precisely damaging single statement in the history of American business criminal prosecution, establishing a public characterization of the defendant that the criminal conviction then confirmed and that no subsequent legal or public relations effort has fully displaced. The tax evasion case produced an 18-month prison sentence and a personal brand so damaged that the Helmsley Palace Hotel eventually removed the Helmsley name from its marketing despite retaining the name in its official title for years. At what point does a business empire's commercial assets become separable from the personal conduct of its controlling figures? Leave your analysis in the comments below. The appraisal of the Helmsley real estate portfolio's commercial assets at the time of Leona Helmsley's prosecution and Harry Helmsley's declining health reflected a specific characteristic of privately controlled real estate empires. The concentration of institutional knowledge, operational relationships, and deal-making capacity in the principals had created a portfolio whose commercial value was genuine, but whose continued optimization was dependent on capabilities that the principal's age, health, and legal circumstances were progressively reducing. The Helmsley Palace Hotel's underlying real estate value was separable from the Helmsley name and the Helmsley management, as the property's subsequent operation under alternative flags and management structures demonstrated. The management fee income that Harry Helmsley's operational relationships had generated across the broader portfolio was less separable, as the relationships were personal and the management capabilities were embodied in an individual whose advancing age and declining health were progressively limiting his operational effectiveness. The appraisal challenge for a portfolio of this type is the quantification of the key person dependency. The premium above physical asset value that the controlling figure's personal capabilities have generated, and the discount that should be applied to that premium when the capabilities are being withdrawn through death, incapacitation, or legal circumstance. Standard real estate appraisal methodology does not contain a robust framework for pricing key person dependency in privately controlled portfolios, because the historical data required to calibrate such an adjustment is not available in the forms that commercial real estate appraisal models use as primary inputs. The Helmsley portfolio's commercial assets retained their physical value through the prosecution, the imprisonment, and the eventual deaths of both principals. The Helmsley Palace Hotel was sold to the Sultan of Brunei in 1993 for approximately $202 million and subsequently sold to a group that includes Northwood Investors, which operates it today as the New York Palace. The office portfolio was managed by entities connected to the Helmsley estate through the years of Leona's prosecution and imprisonment, and was eventually repositioned and partially sold as the estate's trustees executed the liquidation and charitable distribution that her will specified. If the forensic analysis this channel conducts is changing how you read real estate headlines, the like button is how the algorithm knows to send this case file to the next analyst who needs it. Leona Helmsley's public persona during the height of the Helmsley Empire's marketing was the product of a deliberate brand strategy whose execution she had supervised personally and whose consequences she had not adequately anticipated. The Helmsley Hotel advertising campaign of the 1980s, which featured Leona Helmsley with the tagline, "It's the only palace in the world where the Queen stands guard," had successfully established a premium brand identity for the Helmsley Palace that distinguished it from competing midtown Manhattan luxury hotels and generated occupancy rates and average daily rates that the premium positioning required. The same personal prominence that the campaign had created became the mechanism through which the tax evasion prosecution's public impact was amplified beyond what any ordinary business criminal prosecution would have produced. A hotel chain whose brand identity was built on the personal authority and judgment of its controlling figure was uniquely exposed to reputational damage from the disclosure that the controlling figure's personal judgment had extended to charging her home renovations to her hotel's business accounts. The brand that Leona Helmsley had built on her own name became the instrument of her commercial destruction when her name became associated with the specific contempt for law that the prosecution documented. The institutional denial in this case was embedded in the advertising strategy itself. The creation of a brand identity so thoroughly dependent on the personal authority of one individual that any challenge to that individual's credibility became a challenge to the brand's foundational premise. The denial was not in any assessment of the legal risks of the expense charging practices. Those practices were deliberate and extensive enough to suggest that the legal risk had been assessed and discounted. The denial was in the assessment of the reputational risk. The failure to anticipate that a brand built on the promise of regal standards would be specifically and permanently damaged by evidence that the Queen's standing guard was charging her home improvements to the guests. The Helmsley name has not been prominently attached to a hotel marketing campaign since the prosecution. The building is still there. It is beautiful. It charges premium rates. It does not invoke Leona. The New York Palace Hotel at 455 Madison Avenue continues to operate as one of the most historically significant and commercially successful luxury hotel properties in Midtown Manhattan. The Villard houses that Stanford White designed in the 1880s and that Harry Helmsley incorporated into the hotel's base remain intact, operating as event spaces and public rooms that connect the contemporary hotel operation to one of the most significant ensembles of Gilded Age architecture remaining in New York City. Leona Helmsley's charitable trust, which received the majority of her estate following her 2007 death, has been the subject of legal proceedings whose outcomes modified her original instruction that the trust's primary beneficiary should be the welfare of dogs, redirecting the funds toward more conventional charitable purposes while preserving the trust's capacity to fulfill its charitable mission. What the Helmsley Empire case reveals in the context of this channel's 46-case archive is the specific resilience of physical real estate assets against the institutional failures of the figures who control them. Every previous case file in this archive has documented a building that was financially damaged by the failure of the financial structure that its owners had placed on top of it. The Helmsley case documents a building whose physical and commercial quality was sufficient to survive the criminal prosecution, imprisonment, and death of its controlling figure, to outlast the specific brand identity that the controlling figure had built around her personal authority, and to continue generating the premium commercial returns that the Gilded Age architecture and the Midtown Madison Avenue location had always been capable of producing. The Queen is gone. The palace is still standing. The forensic lesson of the Helmsley case is not that crime pays or that crime doesn't pay. It is that the physical quality of a genuinely well-located, genuinely distinguished hotel asset is more durable than the personal credibility of any individual who owns it, and that the specific mechanism by which a controlling figure's conduct damages a real estate empire is the damage to the brand and the management relationships rather than the damage to the underlying physical asset. Leona damaged the brand. Harry's portfolio damaged the brand further through the key person dependency that his death created. The building absorbed both. The palace survived the Queen. If this case file changed how you evaluate the relationship between personal brand and real estate asset value in privately controlled hotel empires, subscribe, because the next case examines what happens when the personal brand is built by a city rather than an individual. And in the comments, given Leona Helmsley's documented construction of a brand so thoroughly dependent on her personal authority that any credibility challenge became a brand challenge, what specific brand architecture for a luxury hotel portfolio most effectively insulates the portfolio from key person reputational risk? The case file is open. This content was developed using artificial intelligence tools as part of the research, writing, and production process. All AI-generated material was subject to human review, editorial intervention, and approval before publication. Factual claims, interpretive framing, creative direction, and final content decisions reflect human judgment throughout. This disclosure is provided in accordance with platform transparency standards for AI-assisted content.